in a nutshell, for those who do not know what we do, we are an investor in a real-world asset. It's a running business investing in real estate secured debt, in a sense that we buy debt from commercial banks, which are secured with real estate. And we currently have just a bit over $500 million of assets under management in euros. That's just below 4,000 properties which are being sold. And that market we operate since 2008. So it's a running business which is going well. And we wanted to do an extension of this business on chain, and we started about a year ago. So up to date, we created one product, which is basically a derivative of the Luxembourg listed bond. And then we're about to launch another product which is has a lower entry barrier in terms of euro or US dollar amount. And what I want to talk, Scott, also with you on this matter is the let's say overall framework, legislative, and how different similar products fit in there, because you come across with them. Maybe we can move. I can do it myself.
There's more slides I haven't seen.
Okay, so this is basically, in a nutshell, the risk scorecard that was given to me by ChatGPT by asking what is the real-world asset, let's say, certification, what is important to, from the risk perspective, how would you perceive the risk of the real-world asset? And these are some of the elements that I was given. We can go one by one. And right, so, the more green dots, the better. The two products are actually different. So the DeFi product, which we are about to launch, the entry ticket is very low. It's about 1,000 USDC. And digital bond is currently only for professional investors with the denomination of 100,000 euro equivalent. So it's Euro C. It's a digital format, but it's a mirror image of the Luxembourg listed bond. I guess the key element and the key problem, and this is, Scott, a question to you. If you would look at the overall distribution of digital products, that being DeFi and tokens, right? DeFi being more, let's say, deregulated, it's just a protocol. Then what would you see in this case? Because what we could capitalize on is a very mere fact of our presence in Luxembourg, the existence of the infrastructure in the first place, running business. Our investors are professional investors, pension funds, institutional investors. We had to build it. So for us doing that and extending this to the crypto world was easy. But what do you see? Curious to know from, let's say, other offerings. Are they to the same, let's say, let me make a big picture so that we can, look at this from different angles. So what's your takeaway? What is the quality of the market of the offerings?
Yeah, thanks, Peter, and thanks for the extended notice about my participation in this session. We Token Investors are a VARA-regulated broker-dealer, so we are working on bringing high-quality assets. We're working with LynxCap on their products and bringing them to market. The ambition for us is to, bridge, and we heard it in some of the panels earlier today. Tokenization offers the promise of accessibility, liquidity, and various other things, but for us, it's all about accessibility. 99% of people in the world are not allowed to buy well-managed, well-structured. You talk about the Lux infrastructure. That's wonderful because, the Lux Stock Exchange and the registrations you have, it brings all of those investor protections. It's a well-managed product. It's a high-yielding product. Why can retail investors not buy it? And that's one of the challenges with TradFi regulations, is they don't allow retail to buy. I'm getting to your question eventually. What have retail been allowed to buy on chain? NFTs, meme coins that go to zero, crypto assets that are highly volatile that don't really represent any underlying necessary intrinsic value. So retail has been allowed to buy unregulated, quite volatile assets, but they continue to not be allowed to buy highly regulated, well-managed, well-structured products like the LynxCap bond product, which we think is a fantastic product. Now, it's the gap between those that I really wanted to pick up your point. This is a really well thought through. These are the key issues as you move through the different asset classes. But what we are seeing happening in practice, we are bringing real world assets to market. For people who saw Sean McHugh from VARA on the stage about an hour ago, he is our regulator. He was referring to some of the projects we're bringing on chain. But it's slow, it's hard work, it's regulated, it takes months of white papers and lots of legal documents. And to do it properly is actually quite hard. What is now happening on chain is the asset quality. When I look at some of the biggest names, and I perhaps won't name things, but if I look at RWAs going on chain today, none of them, they are, I mean, if you maybe go to that other slide, Peter, with the different asset classes, it's kind of in here, but it's that slide there. What do you, when you actually look at the disclaimers for a lot of so-called RWAs going on chain today, and they are being issued in the lighter touch regulatory frameworks, you don't have any of that. Actually, you tend to have what starts, it looks like an RWA, it looks like maybe something that's coming from the real world, but in fact it's a meme coin. It just happens to have the same name with a vague promise of a market maker to maintain a price. This for me is a huge problem because so I'd almost, this slide here, economic exposure only, there's a lot of stuff below here that it's the stuff below here that I'm seeing lots and lots of activity because it's easy to issue. And the defense of those projects is I'm not dealing in securities because you have no claim on the underlying. So no claim at all. And it's kind of the economic exposure only, but even then with no guarantees and no investor protections. So I think the industry as a whole is at risk, which has happened throughout Web3's development of things going wrong because of low quality assets where investors actually don't have any claims. Now, at the higher end, and it was fantastic to see Florian and Evidence, who we partner with in this market, the quality of the assets that we're working with them and the quality of the assets like the LynxCap bond, these are existing, regulated, well-structured, use the words down here, it's private credit RWAs score high because they are boring, recognisable claims. Sure, but actually they're not because they are real and they have real-world intrinsic value that may appreciate, but more importantly for Web3, they have real-world yield, yeah? And it is yield that Web3 is really looking for. Yield in Web3 has to date been crypto emissions. Take your tokens, stake them or vault them or do something with them and earn more of the same crypto. The ability for Web3 financial infrastructure to now use the same financial modeling but with a real world asset that's well structured. And the underlying asset, the underlying yield isn't just crypto emissions, it's hard cash because these are genuine real assets that are actually throwing off real yield. So I actually think we're seeing the two sides converge. Really well-structured products battling the regulatory process of getting on chain, and they will prevail. Unfortunately, we're also seeing a lot of fast-moving, completely unregulated assets that are really coming on chain, and the concern there will be, does RWAs get a bad name when they depeg from the perceived real world?
But let me ask you here, stop you for a second.
Yep.
I'm questioning myself. I don't have access to the information, maybe you do. I would speculate that there's no capital. I mean, if you would be in the arrow dot area or below, you can get some, interest just by luck, I guess, or coincidence, but serious money would not go in, neither in the real-world asset nor anywhere else. Would you agree?
Serious money. There is one of the things I think our journey into the more DeFi ecosystem over the last 6 to 9 months, where we've been much more focused about how do we take RWA yield and growth components into Web3. There is serious dedicated capital in there of significant size, but there's also a lot of other capital. You got to remember, Web3 capital is used to parking itself on top of crypto assets that they know are going to zero in the next couple of months. So they're very used to, they're actually very risk tolerant in that they know this isn't going to last. They know that these crypto emissions are a zero-sum game. And so when we've explored but why would you do this with a crypto asset, the next L2 launch and protocol coin? Because I've got 2 months, I know what it looks like, I can watch, I can manage, and I can still make a lot of money riding this thing that is going to zero between now and when it does. And that's probably been the biggest shock for me. These are still significant amounts of on-chain capital that has a risk appetite that just does not exist in TradFi.
Do people at all, investors are asking themselves, it's a basic, test of the product quality. Do investors at all are sophisticated enough to understand? Do they bring it up for a check?
No.
Why?
I don't know, because they're used to buying crypto assets that aren't real anyhow. And so when you buy a supposed on-chain stock, buried in page, right down the bottom in the disclaimers is this isn't really a stock at all, they just simply don't read it. They never have. They've never looked into it. They've got very used to it. And so for me, there's this education process. As Web3 grows up, looks for access to better products, and Web2 comes on chain, it's that intersection that we're at right now.
Okay. It's a very interesting experiment, I guess, for everyone, because a lot of answers, are not given to basic fundamental questions. So actually, time passes fast. I'm looking forward to having the same discussion in a year from today.
Yeah.
And let's see what will be the...
this is fascinating. This, to me, is the future. The ability to put a real-world, real-yielding asset that is DeFi composable, smart contract driven, this is the genuine future of finance, but the regulators have still got somewhere to go.
DeFi is a word reserved for extremely speculative, not fundamentally grounded projects, which is, the market is what it is, we can just reflect on it.
Yeah.
Our idea is to bring something which is of a qualitative nature because of the base that we have. To what extent this will be in demand is an experiment, research and development project for us.
I think there will be demand, but again, the regulatory gap today is smart. I hear people talking about, we need the transfer agents to get on board. Why do we need a transfer agent in a world where they take a lot of money out of projects, they introduce delay in settlement, they introduce human error and 40-year-old legacy IT system error? We have a thing called a blockchain that does this amazing job of keeping an immutable and instantaneous record of who owns what for free. And that's what these you can build these smart contract models and you can use blockchains and you have that immutable data. But until the regulations go, yeah, that's okay, that makes perfect sense, you no longer need a third-party independent transfer agent, then it's not so much that the technology can solve lots of problems that TradFi regs don't yet acknowledge are a legitimate way of solving that problem.
I guess we're all in agreement that this will be the future because of economies of scale and global presence, no dominance, no cartels. It's good for the economy, but it takes time. Thank you very much.
Thank you, Peter.
That was entertaining. Thanks.
Thank you.
Thank you very much.